So question number 4 of long section. So here we are having a given this question belongs from the consolidated profit and loss and financial position. So we are given the profit and loss of the both the entity as well as financial position of the both the entity, and as well as we are having some additional information. So we will read each one and we will then solve the question. So what is the saying? On 1st October 2007, Pedantic acquired 60% of equity share capital of Sophistic in a share exchange of 2 shares in a Pedantic for a 3 shares in Sophistic. So first, while going to solve this question, we have to do some walking, like we have to do some like 5 walking. So first is the group structure. We have to prepare a group structure. So what is that? The Pedantic is acquiring Sophistic 60%. So 40% is NCI, that means our non-controlling interest, and date of acquisition which is given in the questions, that is on 1st October 2007. So I have written here on 1st October 2007, as well as we have to mention the year in, that is given 30 September 2008. So 2008. So it is the 1 year, the date of time of acquisition is 1 year almost, so we don't have to worry about the mid-year acquisitions, and that's all. So it will be quite easy. So for the rest of the working, so now we have to find is the total purchase consideration. So how much amount that the parent has been paid to acquire the subsidiary. So here it is given that the Pedantic acquires 60% of equity share capital of Sophistic in a share exchange. So here there is share exchange consideration. So share exchange of 2 shares. So Pedantic have given his 2 shares, their 2 shares to acquire the 3 shares of Sophistics. So it means the ratio is 2 by 3. So 60% of total share capital of Sophistic, that is the share capital here we have given in the SOFP of the Sophistic. It is 4,000. So I have taken 60% of 4,000. The ratio is 2 by 3. And we have to take the market value of Pedantic, that is given in the question, that at the date of the acquisition in a Pedantic had a market value of 6 per shares. So be careful. We might be given a subsidiary value of market value of subsidiary shares as well. So be careful while picking up this market value. So we have to take the market value of parents share. So it is 6, and I have multiplied it with the 6. We will get 9600. I have taken 30 in the common. Okay. So now one more thing, it has been mentioned, the issue of the share has not yet recorded by Pedantic. So our what will be the journal entry, that is the investment 90 investment to subsidiary debit 9600, and share capital credit 1600. 1600 because the nominal price, that is face value of share capital capital of Pedantic is rupees 1, here we have given. So when we will multiply 1 instead of 6, we will get a 1600, and share premium 8000 because 6 rupees is the issue value, issue market price. So 6 minus 1 will be the share premium, that is the 5. We will get 8000. So it has not yet recorded by the Pedantic. We need to record this as well while preparing the consolidated financial position. So now what we have to do is, so we will read the additional information which is given, that is the at the date of the acquisition a fair value of Sophistic net assets were equal to their carrying amount. Okay. So sales from the Sophistic to Pedantic, these things also need to be very careful, be read out, because when the who are selling the to whom, I mean parents is selling to subsidiary or subsidiary is selling to the parent, we need to be very careful in this matter. So here in this case, Sophistic is selling to Pedantic, it means subsidiary is selling to parent. So what we have to do is, so we will minus, we will first calculate the perp. So perp means profit, provision for unrealized profit. So what is the sales amount? It was 6 million, 6 million. Okay. and Sophistic made a markup on cost of 20% on the sales. So markup is on markup cost. Markup is on cost. So it means our sales value is 120%. So 20 by 120, and one quarter of these goods remain in the inventory of Pedantic at the year end. So 1 by 4. So we will have our per is 250,000. So we will take a 30 common. So no problem. And one more thing need to be very careful here is that if the all if the, here in additional information it has been mentioned that all of the these goods have been sold, no inventory is remaining, so we don't have to calculate the per amount. So because there is no good remaining with us, so we won't calculate any per amount in this condition. But as it is told that one quarter of these goods remain in the inventory, so we need to calculate the per amount for the one by fourth of the inventory which was remaining with the Pedantic at the year end. So we have calculated. Okay, now uh, in the additional information, it is also told that Sophistic had a receivable due from Pedantic of 1 million, and this means Pedantic had to be payable to Sophistic. So what is the receivable and payable? That means intra transactions 1 million. Okay. Now we will calculate the net asset at the date of acquisition and reporting date of Sophistics. So at acquisition, share capital. Share capital will be same at the reporting date as well as at acquisition. So we have here having a 4,000 at reporting date. It will be same as to the acquisition date. So share capital is 4,000, and now we are having the return earning 6,500 at reporting date. So now we have to calculate at acquisition date how much return earning we are having. So we have given in the question that the 4,100 is the profit for the year of the Sophistic. So we will minus this 4,100 from the closing return earning, that is 6,500. We will get the opening return earning of the previous at the date of acquisition. That means at the start of the year. So it is 2,400. Now one thing I need to told here that in this question subsidiary is selling to parent, right? So subsidiary is selling to parent. We will calculate the per and we will minus this per from the working to, that means at the calculation of net asset. Okay, so we will minus this per from the reporting date, and if a parent is selling to the subsidiary, we will minus this per from the at the time of calculation of group return earning, that is the working 5. So these things need to give attention while calculation, while doing the calculations. Okay, so these things need to be very carefully be seen. Now we will calculate a post acquisition reserve. So it is we will when we will this difference between these two amounts will be the post acquisition reserve, that is 3,850, and we will apportion this amount between the parent and subsidiary. So 60% of parents, that is 2,310, and 40% of subsidiary, that is 1,540. Now we will calculate a goodwill. Goodwill. So total purchase. So total. What is the fair value paid by the parent to acquire the subsidiary? We have calculated earlier 9,600. Wait, I will show you. Here is I am having 9,600. Okay, and now fair value of non-controlling interest. It is also given in the questions in additional information. Here you are having the fair value of non-controlling interest at the date of acquisition was 5.9 million. So I have taken 30 as common, so 5,900, and we will subtract the net asset at the date of acquisition, that is 6,400, and minus 6,400. We will get the goodwill as 9,100. Now we will calculate our working code, that is the non-controlling interest part. So what is the fair value of non-controlling interest? It is given in the question, that is 5,900, and 40% of post acquisition reserve, that is the 1,540, and we will add this two amount, we will get a 7,440. Now working 5, we will calculate a group return earning in the working 5. So we will take a return earning of the parent which is given in the SOFP, that is the 35,400, and now we will add the 60% of the post acquisition reserve, that is 2,310, and we will get the group return earning. So again I am repeating, if parent is selling to subsidiary, so we will subtract per from this group return earning. So in this question, as subsidiary is selling to parents, so we will subtract per from the working too. So be careful in these things while doing the questions. So now we will prepare the consolidated P&L. So now we will add each and every item of P&L one by one. So uh, 85,000 plus 42,000, okay, and minus intra sales transaction, that is the given in the additional information of 6 million. Here it is. So we will subtract. I have taken 30 in the common, so minus 6,000, we will get 121,000. Now cost of sales. So cost of sales, it's 63,000 plus 32,000, okay, and minus 6,000 intra transactions and plus 250, that is our perk we have calculated earlier. So we will get 89,250, and when we subtract this from the revenue, we will get our gross profit, that is the 31,750. Similarly, we will add distribution cost, that is 4,000 plus 3,500, and we will subtract this from the gross profit, as well as we will also add these administrative expense of subsidiary as well as parent, that is 8,000 plus 1,000, that is 9,000 altogether. So we will subtract this administrative expense as well as distribution cost from the gross profit. We will get our operating profit, that is 15,250. Now we will also add the financial cost give of the parent as well as subsidiary, that is 600 plus 400, that is 1,000, and we will also add the tax amount of the parent as well as subsidiary, that is 2,162 plus 1,000. So altogether 3,162. When we subtract this tax as well as finance cost from the operating profit, we will get the profit for the year. Now we have to apportion this profit between the parent as well as non-controlling interest. So one thing also need to be very careful. So if parent is selling to subsidiary, uh, sorry, if subsidiary is selling to parent, we need to minus per amount from the profit for the year of subsidiary, and then we will take the 40%, that is the percentage of share of NCI. Then we will have our NCI profit apportion. If parent is selling to subsidiary, then we don't have to minus this per amount here, okay. So these things need to be very careful while doing the question. We will minus the perf as a subsidiary is selling to parents. So we will take the profit for the year of subsidiary, that is 4,100, minus perf, that is 250, and we will take the NCI portion, that is the 40%, and we will get our value 1540. And when we will subtract this amount from the profit for the year of consolidated, then we will get the parent profit apportion, that is 9,548. Now we will prepare the SOIP, consolidated SOIP. So we will add the non-current assets, so that is the 40,600 plus 12,600. We will get the 53,200, and we will add current asset as well, that is 16,000 plus 6,600, and plus we need to minus that amount due from the parent, where it is, yeah, it is 1 million, so 1,000 we have taken 30 in the common. So as well as we have to minus the per amount from the current asset, because we need to eliminate this from the closing inventory, so that we are subtracting this per amount from the current asset. So we will get 21,350, and we need to add goodwill, as it is also our non-current asset, intangible non-current asset. So we need to add this amount as well. So 9,100 we have already calculated earlier, but I will show you here. We are having 9,100. So while adding all these assets, we will get our total asset as a 83,650. Now we will calculate the equity. We will not add the equity of both parent as well as subsidiary. We will only take parent equity portion on the while preparing the consolidated SOIP. So we will take it 10,000, and plus in the question it has been mentioned that Sophistics has not recorded issue of share has not been recorded by the Pedantic. So we will add this amount in the share capital. So it was 1,600 as I told, because no, face value of the share is rupees 1. So when 60% of 4,000 into 2 divided by 3 into 1, when we will do this, we will get 1600 as share capital, and share premium 8000 as it has been issued on the market value, that is rupees 6, and we are having our face value 1, so share premium is rupees 5. So we will, when we will uh, multiply 60% of 40,000 into 2 by 3 into 5, we will get a share premium as a 80,000. Okay, and we will take a group return earning. We will not take the return earning of the this Pedantic on the consolidated SOP. We have already calculated the group return earning earlier, so we will take that amount in the consolidated SOP, that is 37,710. And we will also show the NCI portion in the equity heading, that is the NCI 7440. So altogether we are having our total equity as 64,750. Now we will calculate non-current liabilities loan. We will add the loan amount, that is 3,000 plus 4,000, that is 7,000, and current liabilities 8,200 plus 4,700 minus 1,000, because 1,000 is payable to Sophistics by the parent. It is 1 million minus 1,000. So we will get 11,900 as our current liabilities. So when we will add these all current liabilities, we will get our 18,900 as a total current liabilities. And when we will add this total current liabilities, total liabilities with the total equity, we will get 83,650. So hence our consolidated SOP is correct, as equation is balanced.